Happy Monday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. We have a big episode, a lot to cover. It looks like it's going to be another very busy week. Let's jump in. Tensions between China and Japan, which we've been following for about a week now, are getting quite serious, with Beijing escalating from the diplomatic to the economic, and as of yesterday, to the military. China heightened tensions with Japan on Sunday, yesterday, by sending Coast Guard vessels to patrol waters around the disputed and Japanese-controlled Diaoyu or Senkaku Islands. The move marks a sharp deterioration in relations between Asia's two largest economies and raises fears of broader fallout. The latest patrol, described by China as a, quote, rights enforcement operation, end quote, follows Prime Minister Takaichi's November 7th statement that a Chinese attack on Taiwan, considered by Beijing to be part of its territory, could trigger a military response under Japan's national security laws. While Japan has long held a policy of strategic ambiguity over Taiwan, Takaichi's explicit positioning rattled Beijing. Already viewed warily due to her hardline stance and ties to the late nationalist Prime Minister Shinzo Abe, Takaichi now faces a major test of leadership just weeks into her term. China responded swiftly and sternly throughout the week, and then on Friday, as we covered with the last episode, the Chinese embassy in Tokyo warned its citizens against travelling to Japan over alleged safety risks, a move that could seriously dent Japan's tourism sector. Nearly 7 million Chinese tourists visited Japan last year, contributing about 20% of its inbound tourism. Chinese airlines offered free refunds on Japan-bound tickets, while China's education ministry advised students to reconsider studying in Japan, citing unverified claims of rising crime against Chinese nationals. The disruptive efforts were immediate. Shares in tourism-exposed Japanese companies slumped on Monday trading this morning. Cosmetics giant Shiseido fell 11%. Department store operator Isetan Mitsukoshi lost over 10%, and Tokyo Disneyland operator Oriental Land dropped nearly 5%. Diplomats warned that without a clear off-ramp, the dispute could escalate further. One senior Japanese lawmaker hinted that sanctions may be contemplated by both sides if tensions grow unchecked. Indeed, this essential ban on tourism to Japan is in of itself a type of sanction. Tokyo, however, has urged restraint. The Chief Cabinet Secretary, Kihara, called on China to take, quote, appropriate measures, end quote, following its aggressive diplomatic posture. On Monday, today, public broadcaster NHK reported that Tokyo will send a senior diplomat to China in a bid to smooth tensions. The spat ends what had been a brief thaw in relations. Takaichi and General Secretary Xi Jinping met warmly just last month in South Korea, momentarily reviving hopes for dialogue. Yet underlying tensions remain, and this latest crisis shows how quickly they can flare. For now, China's patrols and advisories signal a calibrated warning, but continued missteps could bring Asia's uneasy peace into deeper peril. Meanwhile, to China's north, Russian energy giant Gazprom is pressing ahead with its long-delayed so-called Power of Siberia 2 gas pipeline, signaling renewed confidence that the project may finally proceed. The pipeline, which would deliver 50 billion cubic meters of gas annually to China, is seen as Russia's best hope of offsetting lost exports to Europe. After stalling for years since its 2014 inception, urgency around PS2 increased following Russia's full-scale invasion of Ukraine in 2022. In September of 2024, Vladimir Putin and Xi Jinping signed a memorandum of construction, prompting Gazprom engineers to commence detailed technical designs. Industry experts estimate the front-end engineering phase could cost 5 to 10% of the total project, which could exceed $30 billion. Despite the high upfront investment, insiders suggest that spending reflects a belief that China will ultimately agree to the deal. Yet progress remains uncertain. China has made few public statements about the Power of Siberia pipeline 2, and key terms like pricing and supply conditions remain unresolved. Meanwhile, Gazprom is building a 410-kilometer section within Russia, a move framed as supporting local gas needs, but also potentially part of the PS2. Analysts expect pipeline deliveries could begin as early as the 2030s, but even then, Russia's pipeline exports to China would reach only half the volumes once sent to Europe. Financing also looms as a major challenge. Despite a profit rebound in 2024, Gazprom faces heavy debt. China has cautiously opened its bond market for Russian issuers, but political and economic uncertainties still cloud the pipeline's future. Next up, we have two more developments to cover, but first, this is a huge opportunity. About a month ago, I covered Liberty Defense, ticker symbol LDDFF, in the US stock market as a video sponsor. Today, Liberty Defense is a sponsor again, and in just 1 month, this company has 1. Expanded into new international jurisdictions, 2. Signed as a customer one of the largest US-based airports in the world, and 3. Closed multiple sales, and so today we have an urgent update on this company. Shares of LDDFF are available on Interactive, Schwab, Fidelity, and E-Trade, to name a few. The team of incredibly impressive advisors continues to grow. Here is just one example. Liberty Defense raised $45 million to date, and its current market cap is only $17 million. With the $45 million its management has developed and begun commercializing one of the most competitive and innovative products of its kind to make Americans safe and airports efficient and much more travel friendly. This is why this video is so important. Liberty Defense is trading near all-time lows. Liberty Defense stocks are down 85% in 8 months. Liberty Defense is working closely with Trump's TSA in what could be a game-changing moment for the company. The upside potential and the catalysts for Liberty Defense are critical to note. Hexwave. The TSA has issued a mandate that airports must, and I repeat, must begin screening employees for explosive-type threats, including metallic and non-metallic threats, starting April 2026. Hexwave was derived from cutting-edge MIT Lincoln Labs research and enhanced through partnerships with the U.S. Department of Homeland Security and Transportation Security Administration. Hexwave is a walkthrough portal that uses millimeter wave technology, advanced 3D imaging, and artificial intelligence to detect both metallic and non-metallic concealed threats. Unlike traditional metal detectors, which fail against plastic or 3D printed guns, Hexwave scans individuals in real time as they pass through, processing up to 700 people per hour without requiring them to remove jackets, shoes, or items in their pockets. 2. HDAIT, High Definition Advanced Imaging Technology Upgrade Kit. As the TSA starts upgrading these airports over the coming years, this could generate over $100 million in potential sales for Liberty Defense. Backed by the U.S. Department of Homeland Security, co-developed with scientists at Pacific Northwest National Laboratory, funded in part by a TSA innovation grant, and already awarded a sole-sourced contract to upgrade deployed checkpoint systems, the HDAIT kit represents the future of aviation security. There are already 1,000 units deployed across the US alone, but these machines are already showing their limitations. Rather than scrapping thousands of existing machines, the HDAIT kit retrofits current AIT scanners, and with new imaging hardware, advanced signal processing, and AI-backed threat recognition. The result is like turning a 1990s TV into a modern 8K flat screen. The TSA has awarded Liberty Defense a sole source contract, and the patent technology is exclusively licensed to Liberty Defense. What this means, at an estimated cost of $125,000 per upgrade kit, and with 1,000 units in need of upgrade in the US alone, and another 600 to 1,000 abroad, is that for a company with a current market cap of $17 million, the upside is potentially enormous. It is worth doing your research on Liberty Defense Holdings. This is a sponsored feature. It is not individual investment advice. For more information on this company, including disclosures, this is listed in the description below. A big thank you to Liberty Defense for once again sponsoring this episode of China Update. We now continue with regular China Update coverage. In a development of concern for Washington, China is poised to take a decisive lead over the United States in the global race to scale up data centers powering artificial intelligence, according to a new research note from Goldman Sachs. The American bank's report highlights China's aggressive build-out of power infrastructure as the critical advantage. In the wake of power shortages in 2021 and 2022, China embarked on a sweeping expansion of its electricity generation capacity. This includes world-leading investments in renewable energy, coal-fueled plants, and nuclear reactors. By 2030, Goldman projects China will have approximately 400 gigawatts of surplus power capacity, 3 times more than what the entire global data center fleet is expected to require. Quote, "We expect China's spare capacity to remain sufficient to accommodate growing power demand from data centers and other industries," end quote, wrote Hong Cheng-wei and fellow Goldman analyst analysts. While China currently accounts for about 25% of global data center capacity, it is on track to catch up with the US, which leads with 44%. Meanwhile, the US faces a looming bottleneck. Data centers already make up around 6% of the national electricity demand, and with limited new power generation under construction, 8 of America's 13 regional grids are operating at or below critical resource capacity levels. This strain could hamper future growth. Quote, limited effective spare power capacity could act as a bottleneck for future data center developments in the US, end quote, analysts warned. In contrast, China's expanding surplus is positioned to fuel continued AI infrastructure expansion well beyond 2030. And finally for today, a growing rift between European and Chinese arms of semiconductor manufacturer Nexperia is threatening to disrupt global car production, industry leaders warn. Despite China's recent move to ease export restrictions, the split centers around the supply of silicon wafers, basic but vital components used in millions of vehicles every year. Nexperia's Dutch unit has quietly halted shipments of wafers to its Chinese subsidiary amid escalating tensions over control of the company. Wafers made in the UK and Germany are typically shipped to China for assembly before being redistributed to major automakers, but the supply chain is now under strain. Quote, we've got weeks, not months, end quote, said one European car executive, speaking to UK-based The Financial Times, warning that component shortages could soon halt production lines. Quote, the situation is devastating. End quote, they added. The stakes are high. Nexperia's low-margin chips underpin critical vehicle functions, airbags, locks, lighting, yet are produced by few other suppliers. While some wafer deliveries to China have resumed following Beijing's recent easing of export bans, insiders say a broader freeze persists due to animosity between Nexperia's European operation and its Chinese management. Shanghai-based Nexperia China is reportedly stockpiling wafers and scrambling for alternatives, but such supplies could run dry by mid-December. The crisis dates back to late September when the Dutch government seized control of Nexperia on security grounds, invoking an emergency law unused since the Cold War. Officials say they acted on intelligence that Zhang Xuezheng, Nexperia's ousted Chinese CEO and major shareholder of its parent Wingtech, was shifting intellectual property and production capacity to China. Zhang was removed and relations have since deteriorated. We covered all this at the time. Nexperia Netherlands accuses its Chinese division of refusing payment, creating unauthorized bank accounts and sending misleading messages to customers and suppliers. China's wing of the company has denied wrongdoing. European carmakers and their lobby group ACEA say the impasse could cause, quote, devastating supply chain collapses, end quote. Volkswagen has avoided production cuts so far, but admits the situation remains, quote, dynamic and uncertain, end quote. The Dutch are now sending an official delegation to Beijing, hoping to broker an agreement to restore normal operations. Yet the Dutch minister remains unrepentant. Quote, it's like an economic thriller, end quote, he said, adding, quote, I'd do it all again, end quote. For Europe's automakers, time is running out. Continued division within Nexperia could push an already fraught chip supply chain to the brink, just as the industry had hoped its worst shortages were behind it. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I hope to see you for another episode tomorrow.